Rivet, 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 rivet. All right, now for part three. Crime Control Act of 1990, Title XXV of the Crime Control Act, known as the Comprehensive Thrift and Bank Fraud Prosecution and Taxpayer Recovery Act of 1990, greatly expanded the authority of federal regulators to combat financial fraud. This act prohibited undercapitalized banks from making golden parachute and other indemnification payments to institutions affiliated parties. It also increased penalties and prison time for those convicted of bank crimes, increased the powers and authority of the FDIC to take enforcement actions against institutions operating in an unsafe or unsound manner, and gave regulators new procedural powers to recover assets improperly diverted from financial institutions. Next, Federal Deposit Insurance Corporation Improvement Act of 1991, also known as FDICIA. FDICIA greatly increased the powers and authority of the FDIC. Major provisions recapitalized the Bank Insurance Fund and allowed the FDIC to strengthen the fund by borrowing from the Treasury. The Act mandated a least cost resolution method and prompt resolution approach to problem and failing banks and ordered the creation of a risk-based deposit insurance assessment scheme. Brokered deposits and the solicitation of deposits were restricted, as were the non-bank activities of insured state banks. FDICIA created new supervisory and regulatory examination standards and put forth new capital requirements for banks. It also expanded the prohibitions against insider activities and created new truth in savings provisions. Next, Housing and Community Development Act of 1992 established regulatory structure for government-sponsored enterprises, GSEs, combated money laundering, and provided regulatory relief to financial institutions. Next, RTC Completion Act required the RTC to adopt a series of management reforms and implement provisions designed to improve the agency's record in providing business opportunities to minorities and women when issuing RTC contracts or selling assets, expands the existing affordable housing program of the RTC and the FDIC by broadening the potential affordable housing stock of two agencies, increased the statute of limitation on RTC civil lawsuits for 3 years to 5 or to the period provided in state law, whichever is longer, provided final funding for the RTC, and established a transition plan for transfer of RTC resources to the FDIC. The RTC's sunset date is set at December 31st, 1995, at which time the FDIC assumed its conservatorship and receivership functions. Next, Rigel Community Development and Regulatory Improvement Act of 1994 established a Community Development Financial Institutions Fund, a wholly owned government corporation that would provide financial and technical assistance to CDFIs, or Community Development Funds institutions. Contains several provisions aimed at curbing the practice of reversing redlining, in which non-bank lenders target low and moderate income homeowners, minorities, and the elderly for home equity loans on abusive terms. requires the Treasury Department to develop ways to substantially reduce the number of currency transactions filed by financial institutions. Contains provisions aimed at shoring up the National Flood Insurance Program.